September 15th, 2008, Lehman Brothers, the fourth largest investment bank in the United States, declares bankruptcy. $639 billion in assets, $613 billion in debt, the largest bankruptcy in the history of America. The Dow Jones falls by 504 points in one day. A global financial crisis begins. Millions of people lose their jobs, their homes, their pensions, their savings. But here's what is strange. While ordinary Americans were watching their 401k turn into dust, top bank executives had long been saving their money. They claimed, "We did not know. No one could have foreseen this." Robert Rubin of Citigroup said, "This was an event with extremely low probability. Practically no one saw this coming." A lie. Studies showed that top executives of American banks that suffered enormous losses in the crisis of 2008 were selling their shares long before the collapse. They knew about the risks, they understood what was happening, and they were saving themselves while telling you everything is fine. Researchers from Osijek University, Madrid, and Barcelona analyzed the trading operations of top executives at 100 of the largest American banks. They compared who sold shares before the crisis and how these banks suffered during the crisis. The result is shocking. Starting in 2006, when United States housing price indices first began to decline, there were large differences in insider trading between banks with high and low risk. Bankers in the riskiest banks, those that invested the most in mortgage-backed securities, sold their shares more aggressively than anyone else. They were not excessively optimistic. They did not fail to understand the risks. Insiders understood the enormous risk in their banks and were not simply excessively optimistic. That is precisely why insiders in riskier banks sold more shares before the crisis. From 2004 to 2006, the first signals appear. The real estate market is overheated. Home prices rose by 200 to 300% over several years. Subprime mortgages are handed out like candy to people who will never be able to repay their debts. Banks package these shitty mortgages into complex financial instruments, collateralized debt obligations, and mortgage-backed securities. Rating agencies assign them AAA ratings. Absolutely safe. But insiders see the truth. An analysis of insider trading in real estate investment trusts from 1996 to 2010 showed that insiders significantly reduced their holdings already in 2004, before the financial crisis. 2004, 4 years before the collapse. Real estate professionals were already exiting the market. April 2006 is the peak of real estate prices. Then the decline begins. Mortgage defaults grow. What do top bank executives do? Publicly, they say, "Everything is under control. Our bank is safe." Privately, they sell shares. The study showed that managers of the riskiest banks, those most heavily invested in real estate, sold significantly more of their shares than managers of safer banks. Lehman Brothers in 2007 held $111 billion in commercial and residential real estate and related securities. That is double the $52 billion at the end of 2006. The real estate market is falling. Defaults are rising. And Lehman doubles down on real estate. Why? Because Chief Executive Officer Richard Fuld refuses to acknowledge reality. He rejects deals to sell the bank or raise capital because they do not reflect the real value of the bank. But here's the paradox. With the exception of the Chief Executive Officer, who sold a significant portion of his shares, and a lead director and a board veteran with 23 years of tenure, considering their time in office, these directors did not back up their words with money. Fuld sold a significant portion of his shares. He said, "Everything is fine." But with his own money, he voted differently. The worst part was that some banks did not merely exit the market. They bet against it, profiting from the collapse. Goldman Sachs sold toxic mortgage securities to clients while simultaneously buying credit default swaps, insurance in case those securities collapsed. They knew they were selling garbage, and at the same time they were making money on that garbage collapsing. In 2010, Goldman director Rajat Gupta was charged with insider trading after allegedly tipping off Raj Rajaratnam of Galleon Group about a $5 billion investment by Berkshire Hathaway and Goldman during the financial crisis of 2008. Gupta leaked information to a hedge fund. Rajaratnam used it for illegal profit. On information about Goldman, his funds earned $17 million. Zero accountability. The crisis destroyed $12 trillion of wealth. Millions lost their homes. Unemployment surged to 10%. How many top Wall Street executives went to prison? Zero. Neil Barofsky, former federal prosecutor and special inspector general of the TARP program, said, "The people responsible for this incredibly painful economic destruction walked free." Why? Several reasons. Reason one, complexity. Cases of banking fraud are extremely complex. You have to prove intent. You have to prove that a manager knew a product was toxic and intentionally misled others. William Black, chief lawyer of the Office of Thrift Supervision during the savings and loan crisis of the 1980s, noted, "At the peak, we had 1,000 FBI agents working on these cases. In 2008, only 120 FBI agents were working on banking fraud. Not enough resources. Reason 2, the government wanted to save the banks. After the collapse of Lehman, the government understood that it could not allow more banks to fall. Too big to fail. Launching a full-scale prosecutorial attack on banks seemed like a bad idea when you were trying to save those same banks. Reason 3, the narrative. In Washington, a narrative took hold. They made mistakes, they were greedy, but they did not commit crimes." Jamie Dimon, chief executive officer of JP Morgan Chase, said on CNBC, "If someone did something wrong, they should go to jail. But failure in America is not illegal." It sounds nice, but research shows this was not failure. It was a conscious decision. Reason 4, legal loopholes. Insider trading is technically legal if you follow a trading plan or notify the Securities and Exchange Commission. Top executives have smart lawyers who structure sales so that they look legal. Yes, they sold more than usual. Yes, in the riskiest banks, but formally. A trading plan established months earlier. What happened to the key figures? Richard Fuld, Lehman Brothers chief executive officer. He received a subpoena in 2008. He testified before Congress. He was asked, "Have you thought about why Lehman was the only bank that was allowed to fail?" He replied, "Until the day I am buried, I will be asking myself that question." But he did not go to prison. He now consults for other companies. In 2007, he received a bonus of $22 million. In total, from 2000 to 2008, he earned around $500 million. Erin Callan, Lehman Brothers chief financial officer. She became chief financial officer at the end of 2007. She publicly reassured investors that everything was fine. She was fired 2 months before the bankruptcy. The bankruptcy court report accused her of ignoring clear red flags and using misleading maneuvers to improve Lehman ORE's balance sheet by $50 billion. A short career at Credit Suisse followed. Then she left. In December 2008, she took an overdose of sleeping pills and survived. She now lives in Florida. Goldman Sachs. The Department of Justice investigated. In the end, in 2012, it announced that it would not bring charges. The Securities and Exchange Commission filed a civil suit. Goldman paid $550 million in fines. It did not admit guilt. Rajat Gupta, Goldman director, the only one who went to prison, convicted of insider trading in 2012, 2 years in prison. But that was for trading after the collapse, not for the actions that caused the collapse. The system is broken. What should you do? The crisis of 2008 proved one thing. When everything collapses, insiders save themselves first. Ordinary people are left holding the bag. But there are ways to protect yourself. Here is what you need to know. Lesson 1. Monitor insider trading. Insider transactions are public. The Securities and Exchange Commission requires executives to report purchases and sales of shares. Websites such as SEC Edgar, Open Insider, and Guru Focus show these transactions in real time. Red flags? Mass selling by top executives, such as chief executive officers and chief financial officers. Sales in financial sector companies with high leverage. Sales without an obvious reason, not taxes and not diversification. If a bank chief executive officer sells 50% or more of his shares, that is a signal. He knows something you do not. Lesson 2, do not believe official statements. Our bank is in excellent shape. We are prepared for any scenario. Capital is sufficient. Lehman said this 1 month before bankruptcy. Bear Stearns said this 1 week before collapse. Watch actions, not words. If executives are selling, they do not believe their own statements. Lesson 3, diversify out of the financial sector during a crisis. When you see signs of a financial bubble, asset prices, real estate, and stocks have risen by 200 to 300% in a few years. Loans are handed out to everyone. Bank leverage is extreme. Lehman was 33 to 1, meaning $33 of debt for every $1 of capital. Exit bank stocks, hold money in safer assets. Lesson 4, gold and government securities in a crisis. In 2008, gold rose. United States Treasury securities, especially short-term ones, also rose. When everything collapses, money runs to safe havens. Hold 10 to 20% of your portfolio in gold and short-term government securities. Lesson 5, cash is king in a panic. During a crash, everything becomes cheaper. Stocks fall by 40 to 60%, real estate by 30 to 50%. If you have cash, you can buy at the bottom. Warren Buffett in 2008 to 2009 bought assets for pennies. Hold 20 to 30% of your portfolio in cash when you see signs of a bubble. Lesson 6. Read reports. Look at the numbers. Lehman hid risks through Repo 105. a scheme that allowed assets to be temporarily removed from the balance sheet before reporting. If you see, a sharp growth in assets, high leverage, complex, opaque instruments, rising loan defaults. These are signs of trouble. Sell. Lesson 7. Do not rely on ratings. Moody's, Standard & Poor's, and Fitch gave AAA ratings to junk collateralized debt obligations. Why? Because they were paid by the banks that created those instruments. A conflict of interest. Rating agencies do not protect you. Do your own analysis. Lesson 8. Remember, too big to fail. The government will save the largest banks, but shareholders can still lose 80 to 90% of value, as happened with Citigroup and Bank of America in 2008. Bondholders may be saved. Shareholders will not. Final thought? They will do it again. One study suggests that politically connected executives traded based on non-public information about a subsequent government bailout program after the crisis began. Another study suggests that, despite statements to the contrary, many banking executives understood the risks they were taking in the run-up to the collapse and sold their personal shareholdings in their firms before the crisis. 2008 taught us this. The system protects insiders. No one went to prison. The fines were laughable compared to the profits. In 2009, Goldman paid $11.4 billion in bonuses after receiving government assistance. They will do it again, because there are no consequences. Your task is not to be a sheep. Watch the signs, act before the crowd panics. Financial war is a war of information. Insiders have the advantage, but you can watch their actions. And when they run, you should run too. Do not wait until the media tells you crisis. By then it will be too late. Watch the insiders. They always know first.